Today, I'm going to share with you one of the most important pieces of advice you're going to hear all year. All has to do with what you do right now in the stock market and how you can protect yourself and take advantage of the situation we're in. I'm going to use some historical precedent here. I'm going to talk about what typically happens in these kinds of situations. And I'm going to talk about what I am doing as a Canadian investor to put myself in the best possible position going forwards. Welcome to Larch Investing. My name is Liam. On this channel, we love to talk about Canadian investing. If that interests you at all, please do subscribe to the channel. It makes a huge difference. Doesn't cost anything. Now, today we're going to talk about the coming and sort of ongoing economic and stock market chaos. In the last couple of months, ever since the new administration took power in the United States, we've seen some massive changes, and not all of it has been good, particularly for the economies of both the United States and of most of its major partners. As a Canadian investor, I know this very well. We've had a lot of economic shock up here, had some trouble in our stock markets. We've had some companies struggling, and really it's been a tough and stressful time in this country. In fact, it's the main topic of conversation right now, Canadian economy struggling. In the United States, the bellwether for this has been the S&P 500 and related indexes dropping. It's actually been one of the worst drops over the last couple of years. Now, it doesn't really compare to the massive drop in 2022, and obviously it's not quite the same story as 2020, but it has been correcting. For a brief moment, we've seen some indexes drop into full correction territory, only to sort of be pulled out of them. However, with a lot of news events going on right now, including auto tariffs this last week and the coming Liberation Day down in the United States, which is supposed to be the day when there's a lot of reciprocal tariffs put on a lot of US trade partners, there's a lot of fear. And fear in the stock market typically means one thing: stocks going down. This isn't as bad for you as it might be for others, but depending on what your portfolio looks like, what age you are, what sort of work life you have, what sort of financial stage you're at, this could be massively impactful. I'm a young investor. I'm just in the first couple years of my career. I'm really not quite into my peak earning years. And luckily for me, living in a dual income household with no kids, I've been able to invest a good chunk of my income into the stock market. Now, that might not apply to you, but some of this advice may still apply. What I've been doing is very simple, and I'm sure you've heard this. I've been buying the dip. The thing is, a lot of people fall for that idea of, oh, things are going down, I should buy now. But they don't fully understand how to do it, and they don't fully understand how to protect themselves in these situations. That's what we're going to really talk about in this video. Now, the first thing, I think this is super important, and I don't know that enough of us in this community as stock market enthusiasts, right, retail investors, I feel like we don't talk about this enough, but step one is making sure your financial health is okay. But do you have a lot of debt? Are you making more money than you're spending? I think those questions need to be top of the list for any investor. If you're putting money, into the markets and you're paying a 19% interest rate on debt, you got to find some fantastic returns just to break even. And so paying off debt can be a great way to get a guaranteed improvement on your financial situation. Making sure you have enough money set aside is also important. Have an emergency fund, please. If you own a home or a car, or you work in a job where an injury or a life event could prevent you from earning income, you need an emergency fund, particularly when we're looking at a potential recession. If the economy does start to drop, you're going to really, really value that money you put aside. It's worth it. Now, as long as you have both those things, that's when looking at the stock market as an opportunity becomes way less stressful. Because now the money I put into the stock market is not needed for me to eat, for me to pay the mortgage, for me to feed the dog, for me to do any of those key essential things. Instead, I'm investing money I can afford to lose. And that is a key element for all of us as investors. Make sure you're not putting money that you can't afford to lose into the markets, because then you are dependent on the market going up now to pull that money back out. If you take out debt to invest, if you're investing on leverage, you're putting yourself in a position where time is not your friend. And time is the greatest compounding factor in the stock market. So please don't do that to yourself. Once you're in that situation where you're only investing money you can afford to lose, now you have to make the fun decision. What are you going to invest in? Are you ready for the most boring answer? The market. At times like this, probably the best move for most of us is to simply buy an index tracking ETF. Why is that? Well, depending on your situation, how sort of invested you are into watching the market, paying attention to the market, stock picking during a recession can be a real danger. Imagine you were buying during the 2000.com bubble. If you were stock picking, there is a high chance you would have picked a high growth name that didn't play out. And to be honest, right now, we don't know what companies are in that potential list. If you're investing in safe blue chips, what if the economic situation changes enough that those companies never recover? If you instead invest in the average, in the market, in the index, you have a much higher chance of making a much better return, and you don't have to stress about it, which can be huge depending on your situation and how stressful these sort of chaotic times can be. Now, if you're like me and you're sort of a stock market enthusiast, you really love this stuff and you want to pick names, go for it. But I still think a bigger chunk of money should be going into the general market. Now, when I'm talking about general market, I'm generally talking sort of worldwide, but you can obviously pick a specific one, right? You can pick S&P, you can pick the NASDAQ, you can pick the Dow Jones, you can pick the TSX, but just pick an index, invest in an easy ETF. It is the least stressful way to buy in, and it's the best way to maintain conviction. The second most important thing is don't buy all at once. That's something that hits a lot of investors, and you might be a little bit confused because obviously I've talked about how important timing is and how you need to be buying now. But if you buy all at once, you are locking yourself into the price today. What if this correction turns into a 40% crash? I bet you'd wish you held on to some of that money to buy at the lows. Or what if the stock market races upwards? To be honest, none of us really know. And so dollar cost averaging is the time-tested best method. Simply picking a recurring interval and buying a set amount of money every time. The reason why having the money as your set amount is better than having the shares is that obviously as the share price drops, so for example, if you're buying into the S&P 500, as the SPY drops, you can get more for that same amount of money, dropping your average cost basis. Really, really impactful and super important. Something that I even feel like sometimes I do wrong. I'm so locked into buying a couple shares a time, I don't think about it in dollar amounts. I think it's really important. Now, the second and probably the most important part of this is all about timing. And I think it's time to buy now. And you might think to yourself, well, shouldn't I be waiting? Shouldn't I start dollar cost averaging as things hit the bottom and then buy my way up? That might work out for you. But the thing is, when we have these kinds of situations where the market is really shaky and a lot of people are looking at selling their investments, and most people who aren't interested in this kind of thing, who aren't sitting here watching a YouTube video, have probably already started selling or maybe have considered it. There is often a point where things in the economy continue to get worse, but the stock market turns around. I think one of the examples I've seen mentioned the most frequently in the last little while is the Cuban Missile Crisis. And it's kind of a weird parallel to draw, right? We're talking about tariffs and we're comparing that to nuclear war. A little bit of a difference. However, we've seen a pretty similar decline in the stock market as we did back during the Cuban Missile Crisis. That had a set amount of time. It was going on for a set number of days. And actually, the market bottomed about halfway through the crisis. It didn't bottom right before it was resolved. That's why I think buying now could be huge. Because for all we know, we could see resolution next week, 2 weeks from now, 3 weeks from now. And we could see the market just race onwards as it has for the past couple of years. And since we don't know that, there's no value in just completely speculating. So I think the move, really simple. Invest money you can afford to lose. Dollar cost average into a market-wide index tracking ETF and start doing it now. That's my move. That's how I'm going to profit from this economic uncertainty, from this stock market correction. And honestly, I think that's probably the safest and easiest thing for most investors to do. Thanks for watching. If you made it this far in the video, please do consider liking the video and subscribing to the channel. It makes a huge difference, doesn't cost anything. And with all that being said, I hope I see you in the next one.